What is up, Bitcoiners? Welcome back to another episode of Fed Watch. I'm sitting here with Ansel. Ansel, how you doing, my man?
Good. Sorry we missed last week, audience. 4th of July plans got delayed and I couldn't make it back in time. So we have a lot to cover this week.
Yeah, I mean, hey, everything is constantly changing in the world of macro and central banks, and we're here to cover it all, right? With Bitcoin, it's simple, 21 million. It's all about stability, but central banks are the opposite. It's all about kind of uh shrouding things in complexity and the lack of simplicity in order to continue operating the way they do. So we're here to unveil all of that and get right into it. Ansel has a really nice, thorough list for you guys today. So let's just dive right into it. Ansel, you kind of had a kickoff here for us.
Yeah, I just had a summary of kind of the global situation, update on the global economy. So, you know, uh, everybody was kind of synchronized from the COVID crash, right, in 2020. And the whole world kind of entered this recovery mode, maybe a reflation. People were talking about reflation for the first 6 months of this year. And now it appears that that is worn off. And we have several different data points from around the world that kind of show that we are rolling over, possibly going, back into some sort of recession or maybe a double half of this recession. We'll have to wait and see. But the data points that I pulled out here are first the Chinese reserve requirement. They had a surprise cut of 50 basis points. So for people familiar with fractional reserve banking, this is the amount that you have to keep in reserve. You can't lend out. And so usually the Keynesian idea is that you will lower this during bad times, right? Because then you'll get the banks to lend more. And you can increase this during good times, and that kind of smooths out the business cycle a little bit. But if China has a surprise drop in their reserve requirement, perhaps they're sliding out of recovery and back into some sort of slowdown. So that's the first data point. The second data point is the German manufacturing PMI. And Germany is kind of a bellwether economy. They obviously are the largest economy in Europe. They're heavy into manufacturing. And so they kind of are a good proxy for much of the global economy. And just recently now in June, their manufacturing PMI printed below 50. So, or right at 50. I think it was like 49.9. So it's in
What's a
contraction.
PMI, by the way?
PMI is the Purchasing Managers Index. So it measures, it's a survey that uh, questions businesses like, are you doing more business than last month or less business than last month? And any reading 50 is the same. So if it's over 50, that means the economy is kind of expanding. And if it's under 50, that means the purchasing managers are saying the economy is contracting. So
Got
this
it.
reading came in right at 50. And that's bad news. If you think about all of the stimulus, quote unquote stimulus that's going on, going from around 60 down to 50 in 1 month is a pretty big pullback in the German economy. The last data point here from our sweeping around the world summary is Japan and their government bonds. So their 10-year Japanese JGB, the government bond, was as high as 20 basis points earlier this year. And now it's gone back down to zero. So their interest rates are falling. So that means most of the developed economies' interest rates are falling. The dollar has begun to strengthen. And for a recovery and inflation, to continue, then you need to have interest rates rising. You need to have the economy expanding. And you need to have people feeling like there's a lot of opportunities to go out there and create new jobs and expand the economy. But we're not seeing that at all. We're seeing this rollover right before the recovery kind of gets its feet under it. How was that summary?
I mean, it makes sense, and it's very interesting to kind of hear the juxtaposition of strengthening dollar and hyperinflation at home, right? And these kind of like narratives that we'll probably jump into later. But it is just I feel like you can kind of see the backdrop that you put, and then you can kind of put the cryptocurrency and Bitcoin market against it, and it makes this drawdown make a lot more sense, right? Like it's difficult to have a bull market when everything else is kind of tanking right now, and again, that's kind of weighing on Bitcoin too.
Yeah, one thing I didn't put in my notes here, but I came across the headline is junk bonds. The rate on junk bonds in the U.S. is below the inflation rate. So, I mean, there's really no place to put your money. And for me, that is a huge sign or a huge opportunity for Bitcoin because, if there's no real place to put your money to make money right now, Bitcoin looks like a great opportunity. So,
it's the least risky thing on the risk spectrum, right?
yeah,
Like
yeah.
in terms of like there's this like perceived risk spectrum. People perceive Bitcoin to be this kind of like volatile, risky thing. But if you actually understand the fundamentals, like yes, it has the upside, but it's also extremely, extremely conservative and extremely, extremely sound and robust.
Well, yeah, and we are just completing, hopefully, just completing a period of very low volatility for Bitcoin. We've been stuck between 30 and 35,000, and for Bitcoin, that's extremely low volatility.
Yeah, I mean the range has been getting to people too. I can see it on Twitter.
Yeah,
People are getting frustrated. Like this range is people want that upside volatility, especially during a bull market. I definitely want to talk more about Bitcoin at the end of the show, like we usually do. But let's kind of transition to the Fed, right? So you're talking about in the world, the dollar is strengthening. All of these growth metrics are showing, showing that they're starting to decline. That's showing recession and things are getting bad. And then on the flip side, with the Fed and in the US, there's a very strong inflation narrative that is starting to hit the mainstream. And there's a lot of pressure on the Fed to do something about it, and a lot more scrutiny onto what is happening currently with the QE program. You want to hit in on this, Ansel?
yeah. It's interesting because I'm sure the Fed is looking at all of these data points around the world, and they're seeing that it's rolling back over. But they also are getting this social pressure from people in the media, probably some CEOs of some banks and other things saying, oh my gosh, inflation, we're scared of inflation. And so they're going to have to try something. And central banks are not very creative, right? The only thing they know how to do is to increase reserves. So that's why QE happens, is because QE increases the reserves in the system. But now some of the talk that I've seen is that they're going to kind of differentiate between the mortgage-backed security portion of QE and the treasury portion of QE. And there's no reason that they can answer why they're still buying mortgage-backed securities. The banks don't need it. That market, the real estate market, is fairly healthy right now, and so there is no reason to be buying these mortgage-backed securities. And so I think possibly if there is some sort of taper, which Jackson Hole is coming up next month, which is the big yearly meeting of these central bankers, that maybe there will be some talk about tapering the mortgage-backed security portion of QE.
So this is more or less a hunch that you have.
Yeah, it's a hunch, but it's been making its rounds kind of in some headlines and in some articles.
Gotcha. So pressure on the Fed to do something about inflation. Real estate market looks healthy, right? Real estate prices are going up, but that doesn't necessarily mean that it is a healthy market. So mortgage-backed securities, which they probably just never stopped buying since 2008 or 2009 or whenever they started. That's kind of getting some scrutiny. Kind of curious in your mind, if we just play this forward, let's say they axe that buying, like, does the market react to it? Does that affect some aspect of either like the repo markets or the real estate market in general? Like, what's kind of your gut here?
Well, the repo market will be concerned about the treasury purchases, not the mortgage-backed security purchases per se. So one thing they could do is if they decrease the amount of mortgage-backed securities, they could actually increase the amount of treasuries. And so, for example, if they decrease the amount of mortgage-backed security purchases by 20 billion a month, and they increase treasury purchases by 10, they could still claim that they're tapering by 10. But they're in fact increasing this in a certain, they're more tailoring it towards the treasury. So there's a few things that they could do. My guess would be do the least creative thing. And that's probably what the central bank is going to do, because they don't want to rock the boat. So we might see something very conservative, like 5 billion off of the mortgage-backed securities, to test if the market is going to have some sort of taper tantrum, which, if all of these kind of reflationary trades or signals of the trade being done are true, then there could be very well be a taper tantrum, even with a $5 billion cut to the monthly QE.
Yeah, well, I mean, it seems like a lot of it is narratives as well, right? The narrative is going around. Unfortunately, the impression management is a double-edged sword, right? If everyone is just kind of basing reality on what the Fed is saying, then when they're saying things that the market likes, then the market reacts well to it. But when they, say things that, maybe upset people or maybe scare people or whatever, the narrative, I think, can get away from them as well. So I definitely think it's dangerous, and we're seeing this play out. Like, as we're watching this play out, it's just kind of hilarious. We're talking about impression management, and here it is again. Like, they have to impression manage. What they do here doesn't necessarily have a direct outcome that they can foresee, and we have no idea how the market is actually going to respond to any of this.
Yeah, and you brought up the reverse repo stuff, and that hit almost $1 trillion in overnight volume. Uh, and it's, some estimates are it could go as high as $2 trillion in overnight volume. I mean, that is a problem. It's a problem in that I don't think it's, like we've talked about this before, I don't think it's imminent that is going to cause a mathematically, that's not going to cause a problem. What's going to cause the problem is people are going to see 2 trillion and they're going to get scared, right? They're going to say something is wrong. And that is going to inform all of their other market decisions. And it could, I mean, it could have other consequences.
Absolutely, absolutely. So kind of speaking on consequences a little bit closer to retail, Wells Fargo is having some kind of headline shakeups here. You want to dive into kind of what's happening with Wells Fargo, which is a bank that is frequently in the news. This is not kind of the first time that something's been up with Wells Fargo.
Yeah, they're constantly in the headlines, and they remember, when was that? About 2, 3, 4 years ago, when they were signing up customers from extra accounts, and they got in trouble for that, and now they recently paid a big fine for that. And just a couple weeks ago now, I think it was 2 weeks ago already, out of the blue, they said they're going to close all of their personal lines of credit accounts. So why are they doing that? I don't know. They did something similar during the great financial crisis, but it was more tailored towards, like, everybody didn't lose their lines of credit. It was much more tailored to specific risk, people that are more risky. But now they say they're pivoting to other business, some sort of other business, but people are really confused at why they would just close all of these personal lines of credit out of the blue.
So when you say personal lines of credit, like these are credit cards, like mortgages, stuff like that, student debt, like what constitute, just for someone who may be ignorant about the general term?
Well, it wouldn't be like your primary mortgage, but you can go out and get an equity line of credit. So if you have, say you have $50,000 in equity in your house and you want to update your kitchen or your bathroom, you would go to the bank and you would get maybe a $20,000 line of credit, and that would be an equity line of credit. Credit cards, I don't think fall under this particularly, but it's any sort of personal loan that you would get from the bank. It can also be if you are a sole proprietor or you have a small LLC of some sort and you want to take out a personal loan to buy equipment for your small business. I think that would fall under the personal line of credit. So those are the types of things we're talking about.
So it's really kind of an attack again on retail people who are using Wells
Yes.
Fargo in the economy. Can you talk a little bit about like what's the experience for someone who like, okay, Wells Fargo closes these lines of credit, they make an announcement, probably have like a date where these lines close. Like, does that mean, hey, loan is due, you need to go refinance or figure out how to come up with the money by this date? Like, how does that work?
Well, the lines of credit will have a certain term and interest rate, and so those will just they will go to completion, and Wells Fargo just won't do any more lines of credit. And what does that do for these people? Well, it closes their account, and that can ding their credit. So, I mean, I'm not an expert in this particular field, but if you get an account closed by a bank, it's going to ding your credit. So this is very fishy, and I don't really know what they're thinking by this, but my hunch is, again, a hunch, is that they see something coming in the economy and they don't want to be exposed to this type of business.
Okay. I mean, again, makes sense. And I would love to dive into what you think like, let's just say what's happening under the surface. But anecdotally, I'll just kind of add on to the fact that Wells Fargo is kind of a dick when it comes to their customers' credit. When it comes to premium credit cards that have an annual fee, typically every single bank except for Wells Fargo will allow you to downgrade that credit card to a free credit card that the bank offers. So that way you don't close that credit card if you're over it. If you're like, hey, I'm over this, I did the points reward thing, I don't want to renew this next year. I don't want to pay this $200 or whatever, Chase or Citi, they'll let you say, hey, I want to downgrade this card to a free version of the card. Wells Fargo is the only credit card issuer that won't do it. They like if you're done with that premium card and you want to like downgrade it, they just close the card and open up a new card for you. And that dings your credit. So again, like Wells Fargo is not your friend, and that's just like a small example there. But let's talk about what's under the surface here. Like why, like we've been talking about how central bank activity, low interest rates, and QE have all been disincentivizing banks to loan, right? Unless it's like the perfect customer, right? That's going to take on a massive loan. Like, why would they loan it out? They're not going to make any actual income from it. They're not going to beat inflation. Like, there's very little incentive. And here is another example of a bank that's pretty much saying, like, we're going to stop loaning in the future to a certain cohort of people.
Yeah, I mean, the unemployment rate has been very sticky. Again, the reflation type of boost that the economy was supposed to see in the summertime as we reopened and as some of the, kind of stimulus made its way through the economy, we're not seeing that. At least I'm personally not seeing it. And in a lot of the statistics, we're not seeing it. And so perhaps Wells Fargo is seeing that these people aren't going to be able to make their payments. There's going to be another shoe to drop at some point in the future, and we want to limit our exposure to a falling economy or a slowing economy.
Interesting. I mean, again, guys, FedWatch has been ahead of the curve on all of these narratives, on all of these things, at least a couple months ahead. So very interesting to hear about this Wells Fargo news. Very interesting to kind of see how other players start to react if these kind of services start getting more and more limited. I wouldn't be shocked again. When interest rates are hitting zero, what incentive do they have to make these loans? Like this is just operational overhead and risk at some point, right? So it makes sense. let's dive into CPI. Again, we talked deflation a lot in the last few shows. We've been kind of hinting around this like heavy inflation narrative now. And just this morning, people are talking about the CPI numbers showing, above 5% inflation year over year. Ansel, do you want to kind of dive into the CPI numbers?
Yeah, month over month. So from last month to this month, it was 0.9%, almost 1% increase in the CPI, and that's pretty significant. Year over year, so from last June to this June, it was a 5.4% increase. Again, higher than even May, which I believe May was 5.2, and this is 5.4. So the rate of increase is slowing quite a bit here. And my big thing is that there's different components, obviously, to CPI, and people always have opinions about how accurate CPI is and whether the hedonic adjustments are like honest, if they're good for how to measure inflation. I don't think it's perfect, obviously, but I think it's pretty good. There are two big effects very recently, the last few months, into CPI, and that has been the used car portion. Um, I think they said that in May it was 1% of the 5% of the inflation came from the used car segment. And once again, the used cars are very high. I think they've gone up 30 to 40% in the used car index that they actually track these things for the price of used cars just in the last few months. So that's very significant. Also, one of the things people talk about is housing. The cost of houses have gone up, but let me hit oil first. Sorry. So oil has also been going up dramatically. I thought it was going to top out around 60 to 65, but it keeps going to 70, 75 bucks here. And that can have a dramatic effect on the CPI. So oil and used cars seem to be pushing this CPI higher. I did want to get into housing affordability, but do you have any comments so far?
Well, it's interesting, like when the CPI is interesting because I feel like it doesn't necessarily measure everything that's happening in the economy, but a lot of the things that it is measuring right now are being affected, right? And maybe this used car thing is transitory, but in the
Mhm.
current term, it's really being reflected because used cars are something that is, you know, obviously a big part of what is being measured in the CPI. So it is kind of interesting. But then you look at that, and is the CPI reflecting the strengthening of the dollar globally? Like, I don't know. It's just kind of it's really hard to kind of get a feel of what's actually happening, and that's why we need Bitcoin, because the current system can't show us that transparency. It can't. Like, I guarantee you, we will know a lot more about all the supply chains in the world. We'll know a lot more about how all of these markets work as soon as these central bankers and these manipulating central planners get out of the way and allow us to implement a transparent ledger.
Yeah, and it also, to me, it just highlights the need for a very precise definition of what we're talking about. Um, are we talking about asset price inflation? Well, that's going to be a different number than if we're talking about, basic needs, housing, again, used cars and new cars. I mean, the used cars are being affected, obviously, because there's a huge backlog in manufacturing of the new cars due to the chip shortage. So a lot of people are going to used cars, and I think it's worse than trucks. So maybe that's businesses that need F-150s or certain large trucks, and they're having to go on into the used market because they just can't buy any new cars. So that is directly, that's not if a printing thing, that is directly from a supply chain effect on prices. So it's very hard to even talk about inflation, CPI, money printing. You have to pull back every little thread and see where it leads.
Yeah, I mean, again, it's tough to kind of dig into all of it, and I mean, we try to do a good job on this show. Again, like I just kind of think about the last 50 shows we've done and how it has personally set me up to kind of not be as shocked about what's happening in the economy. Where, I talk to other people, even in the Bitcoin space, even in the cryptocurrency space and the economic space, and they're not as well prepared. So thank you, Ansel, for, always, kind of doing this research and putting all of this kind of in front of us and in front of the audience. Let's talk a little bit about Bitcoin, right? So, I mean, obviously, hash rate is kind of making a little bit of a recovery off of its lows the last 2 weeks. But in general, there's still a lot of uncertainty and volatility in the hash rate and mining ecosystem. Beyond that, we're seeing prices dip today. Today is Tuesday. The show is being released tomorrow on Wednesday. I believe is that the 13th? I should have this in front of me. Wednesday the 14th. So, I mean, like let's just jump into like what you're seeing in the Bitcoin market.
Oh man, well, it's been extremely low volatility. It's been pretty boring. Maybe the quiet before the storm here for the next kind of leg of this market. A lot of people are expecting it to drop to the mid 20s before it takes off again. Is that possible? Yes, it's very possible. That would be extremely good buy the dip opportunity for most Bitcoiners out there. But I don't think it's going to go down there. I think we're in a sideways action, and there's going to be something coming up here in the near future, and Bitcoin is going to go on its next leg higher. What do you think? Do you think we go lower before we go up?
Yeah, it's hard. It's hard. I'm not good at price predictions, although I can generally read the tea leaves. I've done a good job of calling like local tops in altcoin mania. I think I've done it the last 2 years pretty effectively, but in general, it's tough to tell when Bitcoin's gonna pump. That's why I just try to stack aggressively and consistently when it is really close to one on the Mayer multiple. So that's the 200-day moving average. Um, yeah, I don't know. Like, I think there's a lot of moving parts right now, and there's a lot of like things that could create a shock and capitulation event. We've already had a couple of those shocks
Mhm.
and capitulation events just in the last month and a half. So we could be up, we could have one or two more. That's not out of the question. But eventually, my expectation is that we're going to start ticking up. My expectation is people are going to keep stacking, but with that being said, this is something that we talked about a lot in the beginning of 2020, which is like, okay, everyone in Bitcoin is super bullish on Bitcoin, but as the economy gets worse and people's personal lives start being affected, their ability to continue to stack, their ability to keep earning and support the Bitcoin price also wanes. So, the dynamics here, there's just so much going on. It's so fascinating. So my assumption is that we continue to like, let's just say, consolidate down and then pop back up because that's what we've seen multiple times. But if that is going to remain accurate or true here, we'll see.
Yeah, a lot of people are talking about this GBTC unlocking that's happening, and so that's coming up on the 18th, I believe. So 4 days from when this is released, and people are speculating that people will short the spot market and buy discounted GBTC at that point. I don't know how well that trade will work, and whether how many people will partake in that trade. Somebody on Twitter was saying there's going to be billions of dollars in that trade, but I highly doubt that. That could be, though, a point in the sand that a lot of people, maybe big money, they're kind of looking at that and saying, okay, well, let's wait and see how that shakes out before we, continue our buying or get into the market. So there's some of those things. Also, as hash rate, like you started this section on Bitcoin here with hash rate, as hash rate does start ticking up and people get their confidence back that, oh my gosh, this is not a death spiral. We don't need China. We have all of these new opportunities out there for Bitcoin mining that, once people get that and get their confidence back, then, it'll just add to the whole general feeling that Bitcoin is back and Bitcoin has turned the corner.
Yeah, the GBTC thing is very interesting. And I mean that trade makes a lot of sense, right? But at the same time, if there is truly that much money piling into that trade, uh, I wouldn't be surprised if that trade gets effed over, just like the Contango trade got effed over, and the GBTC. Was it the cap and carry or the cap, or I forget the name of the trade. Is it what was the name of that the GBTC trade when there was a massive premium?
No, I don't know, cash and carry, something
Yeah,
like
the
that.
cash and carry trade. So, yeah, I mean, like, if there's no such thing as risk-free yield, so
Right.
that's gonna get arbed out, and then people who are too heavy weighted in their short position are gonna get wrecked. So, popcorn. I'm excited to see it.
Yep. More fuel to the fire. Add some shorts on there so we can squeeze them.
Yeah, load up the shorts, please. I love it.
Yeah.
All right, Ansel, this was a fun rip. Thanks for all of these fantastic updates. Do you want to talk about your article that's going to be dropping on Bitcoin Magazine in the next couple of days here?
Yeah, I just did a quick geopolitical survey of El Salvador. So I broke it up into geography, economy, politics, demographics, and tried to look at how Bitcoin was going to affect them. A lot of people have talked about moving there or at least visiting El Salvador. A lot of Bitcoiners are. And so try to set people up with an idea of what to expect maybe over the horizon. Yes, they might have a short-term boost from doing this, but what does it look like 5-10 years down the road? So I'd kind of dive into that.
Awesome. Well, I'm excited for it to get posted, and I'm excited to talk to you about it next week. So next week's episode, we're going to focus on diving into this research in this survey that Ansel did, and we're going to try something new as well. So we'll see if it sticks. But Ansel's going to be dropping a lot more kind of economic content on Bitcoin Magazine, and when it makes sense, we'll be covering it on this show as well. So keep an eye out for all of that. But until then, make sure to follow Bitcoin Magazine at Bitcoin Magazine. Follow me at CK_snarks. Follow Ansel at Ansel Lindner. 5-star reviews, share with your friends, all that good stuff. Peace.